Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hey, Tony.
Evan, today I wanted to talk about the US-China trade war, if we can call it a war. Most people are.
Yeah.
But really from the perspective of what the implications are for Australia and, what impact it's likely to have on our markets here, on companies here, who would benefit, who would lose from the tariffs being imposed by the US. So what's your take on it?
So it depends on how you take what was said by Xi Jinping at his address, his economic address this week, and whether or not you take that as a sign that things will ease and a deal will be done. Now, some people in Washington are suggesting that what he said is a win for the president in talking about the Chinese opening up their borders, opening up trade, allowing high-end manufacturing, things like car, auto manufacturing, plane, so aeronautical manufacturing to actually open up and allow particularly places like the US and Europe with that high-end manufacturing in. The counter argument to that is that the Chinese have been saying stuff like that for probably a decade. And the other thing about it is that the Chinese have a mandate written into their political laws that they want to one day be what they call the planner and maker of their own destiny. They want to be making their own planes. They want to be making their own cars. So that's where this whole IP comes into, this intellectual property discussion and tariffs that the Trump administration has brought in. So if we look at that and take realistically what we still know, which is that tariffs are going to be introduced in some shape or form, because they still will happen, even with what happened yesterday or the day before, is at the moment, if you take them all together, the amount of tariffs to be imposed on Chinese exports to the US is well and truly above the entire exports of US exports to China. So chart on screen, because the argument is this tick for tat. So this chart on screen shows you very clearly that that red line is the total of all the proposed tariffs, and those blue bars show you the amount of exports from the US to China over the years, and it's short.
There's quite an imbalance there.
Correct. So the question is the other. What are the other tit for tat movements China does to even up if the US was to go the whole hog and bring in all of those tariffs they're now proposing, which is about 160 billion US dollars. And that's where the question for the Australian side comes. So the interesting response so far from the Chinese is they've been very, very targeted at certain parts of the American exports they get at the Trump administration particularly. So you would have heard agribusiness being targeted, you would have heard food and agriculture being targeted, and this is where Australia can possibly benefit. So soybeans is the clear one, along with wheat. They have huge amounts of agribusiness going to China from the US. If you were all of a sudden to see a 25% tariff put on US exports to China, our exports, and we have an agreement with China, a free trade agreement with China, that would actually be a benefit to us, is that they might actually see a pickup in Australian soybeans, wheat, corn, canola, etc., going to the Chinese rather than the US. So there is some positives out of the crossfire. The negative, the other side of it, is we already know the steel and aluminium tariff is enacted. That's been signed into law. So the argument that comes with that is that the Chinese could technically send their steel that they've been sending to the US to us here in Australia, and then us importing or exporting that steel to the US. That's what the Americans have already highlighted, that we have not necessarily got a long-dated scenario where we're exempt from it. And if they do believe that we're obviously exporting Chinese dumping coming into this country, that will be taken off that pretty quickly as well. The catch with that is that if the Chinese still do it and bring steel here, we all of a sudden have all this steel cheaply made, much, much cheaper than we can make it, sitting in our ports. So you can very clearly highlight our steelmakers in this country have a threat that if they were to see the distribution of steel going to the US, going to other parts of the world, including us, that all of a sudden we'd have this imbalance, oversupply of steel and steel manufacturers in this country, which we already know have been subsidised by government. Have a look at what's been going on in Whyalla, have a look at what's been going on in other steel melters around the country. We know about, without naming firms, we know about firms here in this country that have had to work very, very hard to change their business model to be competitive in the new global steel aluminium paradigm. The Chinese could alter that very quickly if all of a sudden they start doing it. So long-winded answer, I get that, but it is very interesting. We are unfortunately in the crossfire.
What about our resources companies? Are they likely to be impacted negatively as a result?
Yes, they are. We've also seen that again initially with the initial aluminium and steel tariffs, and now. So the amount of our top three exports by value, so that is obviously in dollar value terms, are iron ore, coal, and copper. You've seen already with the talk of these tariffs, particularly the 301 section tariffs purely aimed at China, they have affected the price of copper and iron ore, and quite dramatically so. The demand from China for exported goods has actually plateaued and actually gone off. Now, you could probably put that down to seasonality as probably a major reason, but it has been slightly stronger than had been last year and the 2 years before that. So there is certainly maybe the Chinese are altering their behaviour in the importation of iron ore and coal and copper particularly because of that. So that brings in your big two in the material space, copper providers here in this country, which have been doing very well because copper is a great sign of growth. Copper is still on a price basis really, really good. But if you did see tariffs being brought in on Chinese goods to the US, copper is the key gauge of that because it's an export. It's a signal of growth because copper is almost in everything that we manufacture or do. It would start to ease off, and that would be a sign that the tariffs have come through in an adverse way.
Now, I suppose the other thing is really just looking at what's happening on the share markets globally. Whenever particularly Donald Trump, sends a tweet.
Yes.
The US market is down 500 points, 400 or 500 points. Next day, he might correct that, and then the market's up again. So we're getting all this volatility in the markets. Is that going to continue?
You'd have to say so. Here's another chart for you. So chart on screen is to show you that in 2018, about 27 trading days out of the 70-odd, so I think it's 77 odd trading days we've had so far, have seen 1% moves in either direction. That is triple the amount of 1% moves in either direction in 2017. So already what you're talking about, the volatility is there. There are reasons for it. Trump is clearly part of it. The White House is the single largest risk event to markets at the moment on intraday levels because, as he said, tweet comes out, contradicts what he's actually saying in public, blah, blah, blah. There are other factors. We know about the bond market and how that led in February. We also know that we are getting tightening scenarios in the US, but I think you do have to take that as a given. We are going to see higher levels of trading in either direction. That's probably, it's gone too far to the other side, but if you look at 2017, I actually see that as an abnormality year. You can't expect markets to be that quiet, that consistent, almost linearly moving up. Excuse the English there, but that is also an abnormal year. It just can't be seen as a normal year. We've gone too far the other way to an abnormal volatility year, but it shows that unfortunately, yes, you're going to have to get used to swings. Interesting though, look at Australia. We actually have the lowest level of volatility in 2018 compared to all the other global markets, which is really interesting. So our volatility in our market has actually been quite low. So although we have followed the US down tended, we haven't gone at the same strength. We haven't bounced back anywhere near the amount either, but we are, in terms of a volatility perspective, very, very low because we are more of a value market than a growth market, and we're more defensive than a cyclical market. And for that, we've been insulated from the real risks that's been coming out of the US.
All right, Evan, we'll leave it there for today.
Thanks, Danny.
Thanks very much. Thanks for joining us on The Economic View.